In this video, I'm going to be explaining to you the mindset that caused me to become a millionaire. And changing your mindset really can change your life because how you think changes how you act. So if you clicked on this video because you're sick and tired of being broke and you're ready to finally get out of debt, start building wealth, start living the life that you know you deserve, then you clicked on the right video. The first mindset that you need to have if you want to become a millionaire is one hungry and willing to learn. So that means if you're not able to even give 20-30 minutes to listen through as I explain a bunch of very valuable slides that are going to change your mindset and potentially your generational wealth, then you're just never going to have what it takes to become a millionaire. So strap in, focus, and enjoy as your mindset becomes closer to that of a millionaire. So I'm sitting here looking at my portfolio up $194,000 today. Feeling quite grateful. This portfolio is now at $735,000 net worth. And this is going to be the second account. I can taste $1 million on this account. And this is going to be the second time that I've grown an investing portfolio to $1 million. The first time I did it, I was using M1 Finance. This time I'm using Interactive Brokers, but it doesn't really matter. The mindset is the same. So I have a bunch of slides I want to go through and show you just how I think about investing in the stock market and how I've been able to build multiple portfolios to $1 million. This portfolio was $1 million. We're getting back to it. We're getting back to it on this one. So let's start by talking about some fundamental facts that you need to know in order to have the millionaire mindset. Because if you don't have the right data, if you're not making your decisions based off of the right information, then it doesn't really matter, how smart you are. It doesn't really matter how good your gut is. And by the way, this is a big takeaway. That I want you guys to get from this video is it's a quote from Peter Lynch. He says that investing is not about how smart you are. It's about your gut. Loose translation on that quote, not a direct quote here there, but really he liked to talk about how if you could add 8 and 8 together and get reasonably close to what they add to, which I think is 16, then you know enough math to succeed in the stock market, and it's really about your gut. That is what determines your ability to succeed in the stock market is how strong your gut is. So let's look at these facts here. So this is the U.S. stock market returns, S&P 500 index from 1872 to 2024, measured using real total returns, meaning that it's adjusted for reinvested dividends and it's adjusted for inflation. So this is the return every single year since 1872. And the first thing that you should notice is that the stock market has way more up years than it has down years. Which should instantly, like if you compare this to a casino, it's going to have more down than up, right? It's going to have more years that you're at the casino, you're going to lose money than you make money. In fact, the casino is so negative that at a casino, you're probably negative every single year, unless maybe, 1 or 2 years out of here, if you're gambling every single day, because somehow you have infinite money. Maybe you win a really big lottery or something. So you have like maybe 1 or 2 years that you're up slightly, but the rest of it, you're red. Well, the stock market's not like gambling. The stock market is investing in actual companies that are, I mean, if you're buying the right companies, or if you're just buying the S&P 500, which is the index of the 500 biggest companies and changes automatically. If another company, grows, it'll kick out one of the top 500 that's not maintaining its growth rate. So if you just own the 500 biggest companies in the US, they are going to be consistently growing their free cash flow per share, their earnings per share over the long term. Which means that over the long term, guess what? Those stocks are going to go up. And that means that just kind of like to start, you just need to know the millionaire mindset. The millionaire knows, hey, if I'm invested in great American companies and the great American economy, then unless the global human population goes through an event that takes us back, centuries, and the whole economy collapses, or we have like nuclear war or something insane like that, in which case you're not really going to care how much money you have. You're going to care about, surviving and other things like that. The millionaire knows that as long as humanity continues to progress without a major disaster, then the market is going to go up over time. And the best companies are going to find ways to provide more value. And if you provide ways to provide more value, then you're going to find ways to generate more value for your shareholders as well. And that's the beautiful thing about capitalism. Now, the second thing that you're going to notice about this chart is there are some big down years. Like, okay, yeah, sure. There's a couple of years where we had over 50% returns in the S&P 500, which is crazy for an index of 500 companies to move 50% up in a year. Like, that's insane. But we've had 1, 2, 3, 4, 5 times where we've dropped over 30%. The index has dropped over 30% in a single year, which is crazy. And like a lot of these are secluded, right? So it was up, down. Okay, that's a big drop, 30%. But then guess what? Up, 25%, up 15%, down a slight amount, then up. So it's just like there's so much bull here, right? So that's not going to be that painful. I mean, okay, it is going to be painful, almost 40%. It's going to be painful no matter what. But what's even more painful are some of these like secret ones here where you have like 3 down years in a row, right? Where it's like, okay, you drop 10%, but then you drop 10%, and then you drop 22% or 24%. Everyone's just giving up. That's what's really painful. Or like, you look way back to the early 1900s, where you have this over 30% that came after a 20%, that came after a prior down year. So these periods, they're hard, right? So there are hard periods. So you need to know that as well. So what does the millionaire mindset know? Well, they have a couple facts behind them. One, they know that the market goes up way more often than it goes down, and it goes up over time. But then the second thing that the millionaire understands and is always calculating into whatever decisions they're making is that the stock market also does go down, and sometimes it goes down big, and you have to understand both of these facts. So over the long term, you're going to go up, and more years than not, you're going to go up. But there are going to be times where you do come down. And then, you have your averages, close to 10% a year over the long term that you are going to be going up. So the baseline of the millionaire mindset here. Just know, putting money into this over the long term, that's already a good start. The odds are in your favor. So that's one of the first things that once I learned that, I was like, okay, I need to learn this game. You mean this is a game that like, like the average person wins at? Okay, then if I can get good at this, maybe my returns can be good. And you know what? They have been. They've been much better, than I was expecting. So let's keep on going into this. So this is one thing that I think gets a lot of people knocked out. Like, this is something that just knocks a lot of people out really early. They get into investing and they have this expectation that stuff's going to go up and to the right. They look at someone like me, and they're like, and I say something like, I've had almost 100% annualized returns since I got started in the stock market, which is crazy. And they think it's just great. But what they don't know is that my first couple of years in the stock market, I went from, $20,000 to $1 million. And then guess what? I crashed down to 200,000. So they don't understand, like there's this crazy roller coaster that happens, and you have to be willing to learn in the reality. Take the lessons, say, okay, how do I improve from this? How do I get better for the next crash to maybe not go down as much? How do I get better in the next run to maybe go up more? How do I find better companies? What did I not see in this fundamental analysis of this company? Like what did their competitor had that maybe made them not succeed as much as I thought they were going to succeed in their industry? Like what did I miss? How can I do better next time? And that's what you're figuring out in the reality. But what happens is people, they might see this crazy run, their friends like, oh, I made so much money, and then it pulls back, and they're like, yeah, that's great. You're up a little bit. That's fine. And then, their friend starts making a ton more money. Or they see people making videos, or they're watching TikToks, and they're like, man, this crypto's flying. Let me put my money in it. They put their money in it, and then they lose, half of their money, or 60%. And they say, this is terrible. This is a scam. This is not a game I want to get in. You just lose money. So they buy something, it goes down, they sell out, and they just never want to touch the stock market or the crypto market again. This happens to a lot of people. It really does. So you have to understand reality. So this is another part of the millionaire mindset, is they understand reality, and then they focus not on not failing, but on the times that things go poorly, on getting better going forward. All right, but guess what? In the reality, you still end up here. So if you just bought and held, it's the same as expectation, just the path isn't as smooth as you assume looking backwards. So this is another way to think about it. On the days, you're up, down, up, down, up, down, so almost half of the days you look at the stock market, it's going to be down. Almost half of them, it's going to be down. On the months, it'll be less will be down, but the months, there'll still be a good percentage of them down. On the years, we were just looking at the years, right? You have far higher percentage of up years than down years, but you still do have some down years. And then decades, well, let's look at decades. On decades, you start to have very few down decades. So let's look at this chart of the S&P 500, same time frame. This one starts just 71, so 2 years before the other one that we were looking at, and then this one goes till 2025. So you can see each of these boxes are sideways periods. So these are periods where the market did not move up, and then each of these super long lines that you can see here are periods of bull market. And then you can see these downward lines. These are periods of bear markets where the market is pulling back a ton. So one thing that you should notice that someone with a millionaire mindset is going to notice straight away is that, wow, these really long bull markets, they are way bigger and they last much longer than the down periods. Like, look at this. It was a massive pullback, 49% down. And yes, it lasted a long time, but 1973 to maybe 1974, 1975, maybe two-year drawdown here. And yeah, losing half of your money, that sucks. If you're margined, like if you have the position that I have right now and you have a 50% drawdown, you're going to get zeroed out. Like, you're literally going to go to zero if you're using margin. So my margin is highly risky. I do not recommend it at all. Like I said, it makes this stuff 10 times more difficult than it needs to be. So keep it easy for yourself, to be completely honest. But you look at these periods of super long bull markets, and it's like, okay, you had a 49% down, sure, but after a 1,500% up, and then what happened after the 49% down? 2,400% up. So yeah, you have a couple drawdowns, 50% drawdown, 100% up, 57% down. This is honestly a very rough period, but then at 800% up, we're currently on a bull market. And if you look, like the current bull market that we're on, it's tiny, like up 800%. Okay, yawns. Like we were just up, 2,400%. In the bull market that started, in the mid 70s. So this bull market can continue much longer. But then the other thing to keep in mind here, so remember we were just looking at decades. Well, there have been several 10-year periods where the market was not up. So especially if you look backwards, like the earlier years of the stock market, there was a lot more of this. Like you can see, in the 70s to 80s, you had a 21-year sideways period, 17-year sideways period, 25-year sideways period. So there are these like pretty insane periods where, it feels like a decade can pass and the market doesn't go up. That is possible during, world wars, Great Depressions. But more recently, this hasn't been as common, but we still did, have a 13-year time frame where it took 13 years to fully recover from a peak. This has happened before. So the other thing you have to understand in the stock market is sometimes you have to be very patient. but generally it's a winner's game. And if you're just looking every decade, you are very, very rarely going to ever find a decade where you're not up. Okay, so this is just kind of putting another visual on this, just getting this millionaire mindset into your brain. So yeah, almost half the time on a 1 day you lose money. On a 1 year, you're going to start making money way more often than losing. On a 10 year, 90% of the time you're going to be making money. On a 20 year, almost 100% of the time you're going to be up every single 20-year period. And if you own specific companies in here, like, trust me, there are companies that have gone up way more than the S&P 500 overall. So this is the important thing to take away from this. So besides just understanding how the market works and how it moves and the fact, it goes up, it goes down, but overall it's going to go up. The most important thing to understand that a millionaire understands is that when they buy a stock, they are buying a business, and the free cash flow of the business is going to be what determines the stock price long term. Now, in the short term, the stock price, it can fluctuate wildly. And you can almost think of like whatever the earnings per share is, like that's the anchor. The real earnings is the anchor. But, the multiple, it could trade for 100 times earnings. It could trade for 5 times earnings. There's stocks that trade in that whole range. I mean, even bigger than that whole range. So that means that sometimes if your anchor is here, the stock price can fluctuate way above the anchor. It can fluctuate way below the anchor. You can move back and forth, but eventually you're going to return to the anchor. So the way that the millionaire takes advantage of the stock market is they understand the business, first of all. So once again, they know the facts. They understand the facts of the business. And then they buy when it's very far underneath the anchor, the intrinsic value. And then they maybe start trimming and moving into better opportunities when it's up here way above the intrinsic value of the business. So understand the stock is going to follow the business long term, but in the short term, the stock is going to give you opportunities to add and opportunities to sell and to add. And it's just up to you to actually do the work, understand the fundamentals, and then know when is the market being crazy. Either on the upside, like valuing way too much future growth in, expecting way too much, and when is it being crazy on the downside and just not seeing any of the good that's actually there. And that is how you take advantage. So if you get really good, really good at spotting incredible businesses that are on the up and up when the stock price is way down, that is when historically I have had a lot of success using margin, because I know the stock needs a triple or quadruple just to get back to fair value. Now that said, it doesn't mean the business, if it's down here, one thing the millionaire understands is it can still drop another 50%. It can keep on going. Now, it's going to recover as long as the fundamentals of the business continue doing well and continue going up. The stock price is going to eventually recover. But it can, in the short, the stock price can keep moving down. So if you do something, if you try to get smart and be like, oh, this is down so much, the business is doing great still, let me put margin in, and it drops another 50%, you can still get zeroed out. So you need to understand that the market is this crazy beast, and the market is not safe. It is not safe. It is good. It is good, and it goes up over time, and it provides value to its owners and to those that it serves, the companies that like its customers, all the customers of the companies. It's good overall, provides value to humanity, but it's not safe. So you have to understand that. Really important that I think millionaires understand. So sometimes I accept, I'm taking a risk here, and I know that I am taking a risk because I think the upside, is much greater than the downside, both in likelihood and in magnitude, is oftentimes when I take those risks. Okay. So a winning investor mindset, or a millionaire investor mindset. And by the way, some of these visuals, they come from Brian Feroldi on X. So thank you so much for that. I just thought some of these were just very simple, but also crucial. So a winning investor mindset says, hooray, my net worth is up when stuff is going up. And then they say, hooray, my favorite stocks are on sale when stuff is going down. And that means that it's always good in the stock market. It's always good because you're either getting offered deals or you're making a lot of money. And honestly, I feel like I'm making the most money when my portfolio is down the most, because I know that I'm buying companies at the best deals. And that means that my future self is thanking me. So when I'm making those buys, at those incredible prices, that is, even though my net worth is down, that's when I know I'm making a lot of, it's when I know I'm making a lot of money. So I have been very excited recently on this pullback, readjusting my portfolio into what I think has the highest upside coming out of this crash. This is average stock returns per year of the S&P 500. And now this is crazy. We can look at 150 years of returns here. So this is not inflation adjusted. And then this is inflation adjusted. So obviously inflation is going to bring down your returns. So let's look at this inflation adjusted side. You can see over 150 years, 7% annualized return. That's crazy. Over 150 years. Like this is like before, before automobiles, before the internet, way before the internet. But we're going before so much of what we think of as modern humanity. And it's like you could buy on your horse, going into the little Western town, getting a stock receipt, and you're getting these returns. And now recently the annualized returns has been going up. And I think it's actually, we're going to have our best period ahead of us. I don't think this is something that can't continue, because we're going to have so much productivity per person improvement due to AI that profitability, returns, productivity, it's like, oh my goodness, man. Like I think the S&P probably is going to have like a 12% annualized return over the next decade or something. I'm a very optimistic person, as you can see. That doesn't mean I think we are also going to have some of the biggest pull downs that we've ever seen, right? Because the market's going to be, fearful oftentimes when it's running up a ton. It's going to have big pullbacks as well. So maybe we'll see like 60% pullbacks and stuff. But overall, like I think we're going to go through the best period of returns in the S&P 500 that we've ever seen. And you can just see the trend that as the world gets more and more modern, as we have the industrial revolution, the internet revolution, it's like the returns have been accelerating. And I actually think that they will continue to accelerate over time. So let me just show you really quick. So in my portfolio right now, I actually only own 3 stocks. I own Hims, I own Lemonade, and I own Tesla. And this is my expected return on investment in 1 year. So you can see Tesla, it's expensive right now. So my calculations actually show it going down, 41% in the 1 year. Lemonade, it has going down as well. Just 'cause Lemonade, don't read into this, by the way, too much. Lemonade's not even going to be profitable in 1 year. So I just threw in like a 1% profit margin on it, just so that the chart, it wouldn't mess up the chart here. But Lemonade's not even going to be profitable in 1 year. So don't even look at that. And then Hims actually has some upside because it's actually cheap and it's growing fast. So in the 1 year, Hims looks like it has 40% upside according to this. So then now we look at 5 year, and 5 year, this I hardly even care about that much, just so you know. It's like, okay, I care about the 5 year, but I care way more about the 10 year and the 20 year. So the 3 positions I hold, we have Lemonade sitting at a 5x. So Lemonade's going to be profitable. This is a real 5x here that I expect. And we have Tesla here sitting at a 6x. And then we have Hims sitting at almost a 10x in 5 years is my expectation. And this is solely, just so you know, this is solely based on expected revenue growth, net profit margin, and then expected price to earnings ratio. So that's what I'm looking at. So this is, I think in 5 years, I'm expecting, I can actually, let me just look here. Yeah, so I'm expecting Hims to have a 15% profit margin, Lemonade to have an 8% profit margin, and Tesla to have a 15% profit margin in 5 years. So now if we go to the 10 year though, and then the 20 year, like let's just look at both of these. So you can see Hims 20x in the 10 year, 50x in the 20 year, Lemonade 30x in the 10 year, 92x in the 20 year, Tesla 21x in the 10 year, and a 59x in the 20 years. So this is just what I'm talking about with like zooming out here. Like I want as much exposure as I can to this sort of upside potential, especially when I think these companies only have this downside potential, right? So the HIMSS doesn't even really, I mean, HIMSS could pull back 50%, 80%, anything can happen, but it really doesn't even, it's so cheap, it doesn't even really have that much downside potential, which is why HIMSS is actually my number one position right now. Number two position, Lemonade, only has, 40% potential downside, and, 92x upside, which is, 9,200% upside over a 20-year period. And you just look at that risk reward and you're like, yeah, I'll take that 40% downside risk for a 92x upside. That sounds like a good deal to me. And that is what the millionaire understands about the stock market. Just one last thing. A millionaire understands compounding. And I'll close it out here. And guys, I'm actually going to have this linked in the description and as the pinned comment. Play with this freaking compound interest calculator. It is insane. So right now, this is what my personal expectations are for myself over the next 10 years. And some people are going to say that I'm crazy. I think I can actually get 40% returns for another 10 years with only a $2 million base. Some people are going to say I'm crazy. I've averaged more than double this since I started investing 6 years ago. So I think I can do this. Look at how insane compounding is. So, okay, yeah, sure. Start with 2 million. That's crazy. It's so insane. Let's say that, let's actually do this for you. Let's do this for you. Let's say that you start with 2,000 and you do this 40% return for 10 years. So the first year on 2,000, you make $800. Year 2, $1,100. Year 3, $1,500. Year 4, $2,100. Year 5, $3,000. Year 6, $4,000. Year 7, $6,000. Year 8, $8,000. Year 11, $11,000. Year 10, $16,000. Now let's actually, broaden this out. Let's broaden it out to 25 years. Give yourself a little bit of room here. And now you see the power of compounding. You just went from, in 10 years, your 2,000 goes to 50 something thousand, 50K. And then in 25 years, you add another 15 years to that, and now it goes to 9 million. Because what happens? Well, we stopped at 16,000. Well, guess what? 23%. Sorry, 23,000, 32,000, 45,000, 63, 88, 124,000, 16 years in. 124,000 is your annualized return at this point. Many of you could already retire. Now, 40% returns, that's not easy to get. I'm not saying that's easy. I think that's really, no one on Wall Street can do it. Okay. None of the professionals can do it. Let me just put it that way. Let's say you could do what Peter Lynch did. Over the if I was putting myself out to like 40 years, I would probably put myself down to like 20% or something, because once my amount that I'm managing goes up a lot more, well, guess what? I can't buy as tiny of companies. I can't move money in and out without actually moving the stock. It gets much harder to really get crazy returns once you start managing a lot more money. So I would bring my return down a lot. So let's say you could get 29% returns, which you could probably just buy Lemonade and get 29% returns over the next 40 years. Like, that's possible. Obviously, this is not investment advice, but I think you could probably make that one decision and you could probably end up here in 40 years. I'm like, not even really kidding. I'm not even really kidding. So yeah, it's quite insane. I mean, you start to see year 40, if you could still get a 29% return, year 40, you're making $11 million on a $2,000 initial investment. So it's just time in the market and actually letting this compounding happen. Let's go back here. Remember this historical returns here. Let's do this average S&P 500 return over the last 5 years. And we're not going to worry about inflation because, I mean, this is the actual dollar amount you're going to be getting. So let's say you start with $2,000. Okay. We're going to reduce this down to the average S&P. So now you're just putting in the S&P 500. Okay. You're going over 40 years, but now I'm going to challenge you guys. If you could actually just put $500 a month in as well, if you could just invest $500 a month. Now, remember, you're not giving this, you're paying yourself this money. So if you actually care about becoming a millionaire, you have to be willing to pay yourself at least $500 a month. If you're not willing to do that, you're not going to become a millionaire. It's like, I don't make enough money. Well, freaking drive Uber for a couple hours a month and you can pay yourself $500 a month. Okay. If there's a will, there's a way. That's all I'm saying. So if you did this, so just put in the S&P 500, put $500 a month in, started with 2,000. Let's just say you start with 500 as well. Let's just, okay, you start with 500 and then you put another 500 a month in over 40 years. Okay. You can get $10 million. So let's see how long it takes you to become a millionaire. It takes you 24 years to become a millionaire doing this. 24 years. Now, a lot of you guys are not going to want to wait 24 years. And that's why so many people will never become a millionaire, because in order to become a millionaire, you have to be willing to get rich slowly. Thanks for watching, everyone. Play with this compound interest calculator. Just see how absolutely incredible it is. Guess how many years it takes you before you start making more in interest than you're putting in? 6 years. That's all it takes is 6 years. And it's now paying you more than you're paying it. Like this having an investment portfolio is having something that literally loves you back. And yeah, you could probably live off of it within 20 years. You know, if you start putting $6,000 a month in it, you could probably live off of it within 20 years. And you know, if you're 20 right now and you do this 500 a month into the S&P 500, so you need zero skill at all, by the way. You can start living at age 50 in 30 years. At 50, you can retire and start living off of like $150K a year or $200K a year. And your portfolio is still going to keep growing another $100K. You know, it's still going to keep growing by $100K a year because you'll have a $2 million portfolio. So this is the mindset of a millionaire investor. Thanks for watching. If you guys found this valuable at all, please drop a big thumbs up. That's all I ask you in return for this. Trust me, I don't need anything else. This knowledge is all the gift I need besides that thumbs up. Hit subscribe for more videos, and I will see you all in the next one.